If you have owned your home for 15, 20, or 30 years, there's a real chance you are sitting on more profit than you think, and a piece of that profit is going to be taxable the day you sell. Not because you did anything wrong, because there's a federal ceiling on tax-free home sale profit, and that ceiling has not moved since 1997. Most sellers find this out from a form their closing agent hands them. I would rather you hear it now while you still have room to plan, because the federal piece is only the first of 3 layers. There's a second federal tax nobody mentions, and there is Oregon, which gives you no discount at all. And there are 2 local income taxes that most people around here, including plenty who pay them, describe incorrectly. I'm Jenny Turner with Lovejoy Real Estate. I'm here to make sure that you don't regret the house you buy or sell, so let's get into this. Before anything else, I'm a real estate broker. I'm not a CPA and I'm not a tax attorney. If you are in an active situation, under contract, or planning to list this year, stop watching and call a tax professional today, not after you accept an offer. Everything here comes from the IRS Publication 523, IRS Topic 701, 409, and 559, Section 121 of the Tax Code, the Oregon Department of Revenue's 2026 Estimated Tax Publication, and the City of Portland Revenue Division's own page on the 2 local taxes. All linked in the description. I want you checking my work. The examples are illustrative composites, not clients. The numbers show how the rules work, not anybody's actual return. And this is current law as I record. There are at least 4 bills in Congress that would change the ceiling. Some would double it, 1 would remove it entirely. None have passed. If you are watching this a year from now, go verify it. This stuff changes all the time. Here is a belief that almost every homeowner starts with. Selling your primary home is tax-free. Done. For most people, that is close enough to true that it never becomes a problem. But it comes from a rule with a ceiling. Single filer, up to $250,000 of profit excluded. Married filing jointly, up to $500,000 of profit excluded. Those numbers were set in 1997 and have never been adjusted for inflation. When the IRS publishes its annual inflation adjustments, Section 121 is not on the list. That is a ceiling standard still, while everything around it moved. So here's the question this video answers. If you have owned a home a long time in a neighborhood that is appreciated, do you actually know whether your profit clears that ceiling? And do you know what happens to every dollar that does? So let's start with what gets taxed and what the 2-year test really says. Your taxable profit is not your sales price. Start there. Take your sales price, subtract your selling costs, and that includes your agent's fees, which is expressly on the IRS's list. This gives you your amount realized. Then subtract your basis, what you paid, plus your original closing costs, plus every qualifying capital improvement along the way. New roof, kitchen modernization, an addition, a furnace or a heating system, painting, fixing a leak, replacing broken hardware, that's maintenance and it does not count. The amount realized minus the basis equals your gain. That's the number the ceiling applies to. Now, the 2-year test, and I want to be more precise than the shorthand because it hides 2 things. The rule is for 24 months of ownership and 24 months of using the home as your main residence, both inside the 5-year period ending the day you sell. They do not have to be the same 24 months. And if you are filing jointly, only one of you has to meet the ownership test, but both of you have to meet the use test individually. Clear that with a gain under the ceiling and you likely owe nothing federally. One catch. If your closing agent issues you a Form 1099-S, you report the sale whether the gain is fully excludable or not. And if your gain runs over, only the excess gets taxed, not the whole gain. That distinction is worth a lot of money and a lot of unnecessary panic. Let me walk you through an example. Call her Diane. Diane and her husband bought in Alameda in the late 90s and never left. When they sat down with their accountant ahead of a planned sale, the gain came out close to the $500,000 joint ceiling. Close, but under. Then they asked about the kitchen remodel they had been considering before listing. Here's the part that tripped them up and tripped me up the first time. A capital improvement adds to your basis, and a bigger basis means a smaller gain. Spend $60,000 on real improvement, and your taxable gain drops by $60,000. That part is pure good news, and I want the direction clear because it gets stated backwards constantly. The other half of the trade is that the remodel was also going to move their asking price. If the kitchen cost $60,000 and raised what a buyer would pay by $90,000, the basis went up $60,000 and the price went up $90,000, and that $30,000 difference landed on top of a gain already brushing up against the ceiling. The remodel still made the money, it just pushed a slice of the gain over a line they did not even know existed. So let's talk about the second part of this, the federal layer that nobody mentions. You have heard that long-term capital gains get taxed at 0, 15, or 20% depending on your income. True and incomplete, and the missing piece is the most skipped number in exactly this situation. There is a second federal tax called the net investment income tax, 3.8%. It applies once your modified adjusted gross income clears $250,000 for a married couple filing jointly or $200,000 for a single filer. Like the home sale ceiling, these thresholds are not indexed either. Here's how it reaches your house. The IRS is explicit that this tax does not touch the portion of your gain that the exclusion covers, which tells you exactly what it does touch. The portion above the ceiling is net investment income, squarely in scope. So the real federal top end on a gain above your exclusion is not 20%. It is 23.8%. One mechanical detail, because it changes the size of the bill. The 3.8% applies to the lesser of your net investment income or the amount your income exceeds the threshold. If the gain is what pushes you over, only by the amount of the threshold gets hit. If you are already above the $250,000 before the sayer, the entire taxable slice gets it. Okay, Section 3, Oregon and 2 local taxes that are not Portland's. At the federal level, a gain above the exclusion at least gets the preferential capital gain rates. Oregon does not do that. For a home sale, Oregon has no discounted capital gains rate. Your gain is added to your ordinary income and taxed at the graduated rates, which top out at 9.9%. Holding the house 30 years buys you nothing at the state level. $1 of home sale profit is treated like $1 of wages in Oregon. Because Oregon starts from your federal taxable income, your improvements and your exclusions both flow through. So does the leftover. Let me run one more example through, and I'll state my assumption out loud so you can check it out. Married filing jointly, gain above the $500,000 exclusion, $100,000 over. Assume their other income that year already puts them north of $250,000 because that's what makes every threshold here bite. Federal capital gains at 15%, $15,000. Net investment income tax at 3.8% on the full $100,000, $3,800 more. Federal total, $18,800. Oregon at 9.9%, $9,900. $28,700 before any local tax. Now the local tax. And I need to correct something you have probably heard. These are not Portland's taxes. The Metro Supportive Housing Services tax is a 1% tax levied by Metro, the regional government. Its revenue is distributed within parts of Clackamas, Multnomah, and Washington counties that sit inside the Metro District. So Beaverton, Hillsborough, and Oregon City are all in it. The Multnomah County Preschool for All tax is a county tax, 1.5% over $200,000 of Oregon taxable income for joint filers, plus another 1.5% above $400,000 income. The City of Portland's Revenue Division administers both on behalf of Metro and on behalf of the county. That's why everyone calls them Portland taxes, but they're not, and the Portland city limits are not the boundary for either one. For our couple, inside the Metro District and in Multnomah County, these two add to roughly $2,500 on the taxable slice, $31,200 total on $100,000 of gain. Just over 31 cents on the dollar. And one more correction. This one's something I have said too strongly myself. People claim that the Oregon tax bill can exceed the federal tax bill. In our example, Oregon is $9,900 against $18,800, a little over half. But there is one case where Oregon genuinely wins. In a low-income year, if part of your federal gain can land in the 0% capital gains bracket, while Oregon still taxes it at 8.75% or more. For the current year's 0% breakpoint, check IRS Topic 409. I won't quote a number here that changes absolutely every January. For anyone in Vancouver, Camas, or anywhere in Clark County, none of this Oregon or state piece applies to you. Washington does not tax this gain. Your picture is the federal picture only, which makes this materially different math problem on your side of the river. However, you do need to remember about the Clark County transfer tax, so keep in mind if you're in Clark County, that can make the math a little bit different as well. In Salem or Eugene, neither local tax reaches you either. So what happens if you've ever rented your house out? Now, we have two separate problems in this situation. This is the section of all this that I had to read 3 times, and I keep publication 523 open when I talk about it, because this is pretty confusing. Most people who cover this mention depreciation, recapture, and stop. Recapture is real if you claim depreciation on a rental portion of your home or were entitled to claim it whether you did or not. That slice of gain gets taxed separately at up to 25%, and the exclusion does not cover it. One date matters enormously for this audience. Section 121 only reaches depreciation adjustments after May the 6th, 1997. If you rented a room in 1994 and stopped in 1996, there's nothing to recapture. So May 6th, 1997 is the magic date. But for anyone who rented the whole house out for a stretch and then moved back in, recapture is a smaller problem. Under Section 121B5, any period after 2008 when the home was not your main residence counts as what the IRS calls non-qualified use. The gain lining up with that period does not get the exclusion at all. Not reduced, not partially. It is carved out before the ceiling ever applies. This is confusing, and this is where people think that they can move back into their rental, live there for 2 years, and then have everything be excluded. And that's just not how it works. Picture someone we'll call Kevin. Kevin and his wife jointly filed and have owned the house for 24 years. For 4 of those years, a work assignment took them out of state, and they rented the whole house out. Then they came back, lived in it for another 8 years, and sold their house. They passed 2 of the 5 tests with room to spare because they both lived there the last 8 years, and they still lose a slice, which is exactly why this catches people. 4 years of non-qualified use out of 24 owned is 1/6 of their ownership. Their gain is $600,000. 1/6 of that, $100,000, is allocated to the non-qualified period and gets no exclusion. The remaining $500,000 is eligible, and the $500,000 joint exclusion covers it exactly. So they owe tax on $100,000 they assumed was protected, and the depreciation from those rental years gets recaptured on top of that. One more line worth drawing because Publication 523 draws it hard. If the rental space was inside your house, a spare room, a home office, a basement room that is part of the same living space, you only deal with recapture and the rest of your gain still gets the exclusion. But if it was a genuinely separate unit, a detached ADU, a duplex where you lived in one side, a basement apartment that is its own dwelling, the gain allocated to that separate portion gets generally no primary residence exclusion at all. Which side of the line you are on that is a question for your accountant. And if you moved out and rented it right up until the sale, that is a different facts pattern with a different answer. Do not assume Kevin's math is yours. Real question for you. If you have owned your home more than 15 years, do you actually know your basis? Not your purchase price, your basis, with the improvements added in. Drop in the comments, yes, no, or I have a shoebox somewhere. I ask because the next section is about that shoebox, and I want to know how many of you guys have one. If you are thinking about selling a long-held home anywhere in the greater Portland, Salem, Eugene, or Southwest Washington area, we can help you pull your real numbers and get a tax professional looped in before you list. No pressure, no obligation. The point is clarity, not a signature. And wherever your next move takes you, I have a referral network of agents that I've worked with directly, and I would personally refer to my friends and family. Reach out, I'm happy to make the connection. The 3 things that actually shrink the bill. Okay, this next part is important. Enough about what it costs, here's what actually moves the number. 1, your receipts. This is your shoebox, at least maybe it might be my shoebox. Every qualifying capital improvement you can document raises your basis and lowers your gain, dollar for dollar, federally and in Oregon. What you cannot document, you generally cannot claim. Let's talk about an example client, Robert. 20 plus years in Woodstock, a full kitchen remodel, a finished basement, a new roof. He spent that money and kept nothing, figuring he would remember the highlights. When his accountant asked for documentation, vague memories were not enough and his taxable gain came out higher than it had to be. Keep the contracts, the invoices, the permits. The IRS's own guidance is to hold your basis records well past the year you sell, not just until you sell. A folder costs you nothing. Number 2, a basis step-up, for which many of you is bigger than the actual exclusion. If your spouse has passed away, ask your CPA about this before you ask about the exclusion. The basis on your late spouse's share resets to fair market value on the date of death. In Oregon, if you held it as joint tenants or tenants by the entirety, half of the house steps up. That can make a huge difference. Before I run the numbers though, one condition you need in hand, because the math depends on it. There is a provision letting the surviving spouse use the full $500,000 exclusion rather than dropping $250,000 if the sale happens within 2 years of death and you have not remarried. There are more conditions than that, so treat it as a reason to ask, not a conclusion. But the example I'm about to walk you through assumes that this 2-year window is still open for this person. And here's what the step-up does. Bought in 1995 for $180,000, worth $900,000 at the date of death. Half the old basis is $90,000, half the current value is $450,000. So the new basis is $540,000. Sell at $950,000 and the gain is $410,000, which that $500,000 exclusion swallows whole. Sell after the 2-year window is closed on you and you are back to $250,000 and $160,000 of that gain is taxable. Either way, the step up did the heavy lifting. Without the gain, it would have been $770,000 and $270,000 of it taxable, even with the full $500,000 exclusion. Okay, that was a lot of numbers, but my point is, if your spouse passes away, if you have a situation with a bunch of equity, talk to your accountant. That's really the magical answer, because it might make sense to sell that property within your 2-year window from a tax perspective, or it might not make much difference to you at all. And it really just can depend. In Washington, though, it's a little bit different because Washington, remember, is a community property state and Oregon is not. So in Washington, the whole house steps up, not half of it. Meaningfully better, and another reason the Clark County picture is different. Number 3, the timing. The rate on your gain depends on your total taxable income for the year, including the gain itself. If your income in the year of sale is unusually low, part of your gain can land in the 0% federal bracket. That matters most for someone between jobs, on a planned sabbatical, or who has stopped working but not started the required retirement account withdrawals yet. Oregon offers no 0% equivalent, and this is one input, not a reason to time the biggest transaction of your life around a tax bracket. Partial exclusions do also exist if you have to sell before hitting the 2 years, for a work-related move meeting specific distance standards, a qualifying health situation, or an unforeseeable event. Divorce, a death, and a natural disaster are all on the IRS's list, and all of them are narrow enough to be worth asking about rather than assuming. So does any of this reach you? Here's how I'd like to sort it. Owned under 10 years or your area has not appreciated dramatically, your gain is very likely under the ceiling and none of the Oregon or local layers will even add up for you. But owned 15 years or more where values have appreciated significantly, definitely run your real numbers with a tax professional before you list. Ask about all 3 layers: capital gains rate, the 3.8% net investment income tax, and Oregon Plus whatever local taxes reach your address. You rented the whole house out and then moved back in? Front of the line. Ask about the non-qualified use under Section 121B5 first, depreciation, recapture second, in that order. You had a tenant in an ADU, a basement apartment, or the other half of a duplex? Ask whether that space was inside your dwelling unit or separate from it. The answer changes whether the exclusion covers that portion even at all. You lost a spouse? Ask about the basis step up before the exclusion and about the surviving spouse provision and its 2-year window. You are planning a remodel before listing? It raises your basis, which definitely helps. If it raises your price by more than it cost, the net effect on your gain runs the other way. Worth modeling and keeping every receipt. You're in Clark County? Federal only. Washington does not tax this gain, except for the Clark County transfer tax. And if you are a surviving spouse there, the community property step-up is more generous than Oregon's. 3 things to take with you. The federal ceiling is still $250,000, still unindexed since 1997, and the real federal rate on top of anything above it is 23.8%, not 20%. Oregon adds a layer with no long-term holding discount at all, and the Metro and Multnomah County taxes on top of that are a regional tax and a county tax, not Portland taxes, no matter who mails you the form. And if you ever rented the place out, non-qualified user rule can carve out a slice of your gain before the exclusion ever even applies, even if you pass the 2-year test easily. Know your real numbers before you list, not after you accept an offer. And again, I'm a broker, not a CPA. Run these numbers with a tax professional. My sources are linked below, and I'd rather you check them out than take my word for it. If this gave you something to look up, hit like and subscribe and send it to anyone you know who has owned their home for a decade or more. Our contact information is right below this video. I'm Jenny Turner with Lovejoy Real Estate. Thank you for watching, and we'll see you in the next one.